Before we start this week's show, Andy, I just want to say a quick thank you to our sponsor, Hargreaves Lansdown. For more information about Hargreaves Lansdown, go to hl.co.uk. And remember, with investing, your capital is at risk, which means the value of your investments can go down as well as up.
Hello and welcome to episode 363 of the Money to the Masses podcast with your resident expert. As always, Damien Fay and me, Andy Leaks. Damien, welcome back. We're here again. How are you doing?
I'm good, thank you. It's nearing the end of the tax year. This is the last show before the tax year end. And if you work in money, you'll know this is the busiest time of year for anything related to finance, as people rush to take advantage of their ISA allowances or pension contribution allowances. So we're always really busy at this point, and then it's kind of as we get into the back part of April. So yeah, busy this week. We've got a lot on the show. In fact, one of the pieces we're going to do this week is relating to the tax year end and the checklist of things that people should have done or they should be considering if they can afford to do them. But it's been a good week. We had some good reviews as well. I'm probably not going to have time to read them out this week, unfortunately, because we've got so much to do on the show. So we'll do that next week, Andy, I think. We'll cover some of the reviews that we've had. But please do leave a review for us this week, because then we can read them next week. And who knows, you may win a Money to the Masses mug as well. So you can do that on iTunes or whatever app you use to listen to podcasts.
Great. So you give a bit of a heads up there on what's coming up in terms of the end of year to-do checklist. What else have we got coming up on the show?
So the other two pieces I'm going to do this week, one of them is to do with green energy. So there are lots of green energy tariffs out there. And we had a question from somebody on Instagram, which was very valid. Why was their energy bill going up when they're on a green energy tariff? So what's that got to do with oil and gas prices if their tariff is generally generating electricity from green sources? So I'm going to explain that. And the other thing I'm going to talk about is money fears. Now, everybody has a money fear of some kind, or they usually do. And it's a key thing that drives us in our behavior when it comes to money and our relationship with money. So I want to talk about money fears and how to overcome them.
Okay, so let's start with the end of year tax checklist. What have we got?
So we do this most years, come back and do this checklist, but it's still worth doing it because there may be things on here that people hadn't thought about doing. Now, you don't have long left if you listen to this podcast on the day of release, because don't forget the tax year ends on the 5th of April each year. And that is a deadline for a lot of different things relating to tax and personal finance. So I'm going to rattle through these because there's quite a list. So first of all, we're going to start with pensions. Now, you may want to pay into your pensions because they offer a tax efficient way to invest for your retirement. But don't forget that there are limits on how much you can pay into a pension each year and receive tax relief. So you can receive tax relief on contributions up to 100% of your earnings, capped at the annual allowance of £40,000 or £3,600, whichever is greater. So making pension contributions can actually lower your income tax bill effectively because you get that tax relief, so your overall bill for that year. I'm not including the money purchase annual allowance in that, so if you want to know what that is, go back and look at our past podcasts. But effectively, the reduced allowance if you started drawing on your pension, where your annual contribution limit drops from £40,000 a tax year to £4,000. Of course, you can also carry forward pension contributions from unused pension contribution annual allowances from previous 3 tax years. So that allows you to pay technically more than the £40,000 annual allowance to get tax relief, as long as you've got the tax that you've paid to be able to recover. Some people will pay into their spouse's pension, so don't forget you can do that even if they are a non-earner, and you get tax relief on those contributions, but up to a set limit. So if you pay money into your spouse's pension as a non-earner, you can pay £2,880 each tax year and receive an additional £720 from HMRC. We are going to put a link to an article that we produce each year that has a list of all the things I'm talking about that will give you a little bit more detail if you're interested. Of course, there are junior SIPs, so you could pay into a pension for your children, which works in the same way as paying into a pension for your spouse, that extra tax relief. And of course, you can boost your state pension too, so you can top up any shortfall in your national insurance contributions. So normally you have to do that within 6 years, so you can pay additional voluntary national insurance contributions. There is a link in the article that will take you through to the relevant part on the official website that allows you to do that. So moving swiftly onto investments, then you've got your ISA allowances. So don't forget that you can put £20,000 a year into a stocks and shares ISA, cash ISA, lifetime ISA. There's a maximum £4,000 limit on a lifetime ISA, or an innovative finance ISA. I always struggle to say that one, Andy. So that limit is a joint one across all of those. So don't forget, if you put money, investments inside those wrappers, they are sheltered from income tax and capital gains tax. One thing I must stress actually is that anybody who is thinking about whether they want to invest in an ISA, whether it's a pension, any of these products that are tax year specific in terms of contributions, for example, could be a junior ISA. Don't forget that we review all of these on the Money to the Masses website, but we also have best buy tables for all these products, whether it's ISAs, SIPs, you name it. We have reviews of them, including the cost, the performances we look at, the features. So go onto the Money to the Masses website. You will see at the top a hyperlink that says Best Buys. Click on that drop down and you will see Best Buys on savings tables, stocks and shares ISAs, all the things that I've mentioned, trading accounts, robo-advisors, you name it, it's there. But you can also navigate to it on a big button on the right-hand side, just below my smiling face on the homepage that also says Best Buys. Moving on, you've also got your capital gains tax allowance that most people forget about. So that's £12,300. Now, I mention that because if you have investments, there are ways in which you could use your annual allowance and effectively maintain your investments over time, because you've got to think about what happens with capital gains is that if your investments keep growing, as you hope they do over time, then when you eventually crystallize the gain, then you'll have to pay capital gains tax on that. And you have your annual allowance, which is deducted from that gain, but you will have to pay, as I said, capital gains tax. But you can, as you go along, effectively almost reset the price that the investment was bought at, so reducing any tax that you pay. So some people do each year, if they have investments, try and use their CGT allowance, even if they maintain their investments. Now, there are set rules that don't just allow you to, for example, sell some investments that you have. So let's say you've got some units in a unit trust one day and then buy them back the next day. So effectively crystallizing the gain using your annual allowance, and therefore meaning that as you go forward, effectively your gains on that portfolio outside of any stocks and shares ISA or pension, so I'm talking about something like a general investment account, it can mean effectively you don't pay any tax on those gains. So because you can't sell one day and buy back the next, because there's this 30-day window that's now a rule, that means you have to wait 30 days before you can buy the investment back. Otherwise, HMRC looks through that transaction as if it didn't happen. So there are things called bed and breakfasting rules, and it used to be that you could sell one day and buy the next. That was bed and breakfast. Rules have changed, but you could bed an ISA, which means you sell your investment that might be in a general investment account and you rebuy the investment inside a stocks and shares ISA. So that will use some of your allowance, but it means that you've shifted investments from a taxable environment into a tax-free environment. You've actually used your CGT allowance as well, which is fantastic, but you won't be taxed going forward on those investments. And this has changed over the years because you can now, on a lot of platforms, I've seen it on Fidelity, for example, that you can definitely do it. There's a form that you can just click and say, right, I want to move that investment effectively inside my ISA. And what they do is they sell down the investment in your general investment account and they will buy it back inside your ISA. And so that is allowed. You can do a similar thing with SIP. So you could sell an investment outside of a SIP and effectively buy it back within a SIP. So you might put money in your SIP and then buy that investment yourself. So that's all you're doing. You're selling outside and you can just get the money and move it back inside. But some platforms do the transaction all for you. There is, of course, something where you can do bed and spousing, they call it. So you one day you sell the investment and your wife or husband could buy the investment back themselves. And then ultimately they can transfer the investment back to you. So what you've done is crystallize that gain, use your CGT allowance, but effectively you've reset the price that any future CGT calculation will use. Because don't forget, to work out your profit, they take the price you would in future sell an investment at, and they would take it away from the price that you purchased the investment at. And the other thing you could do, this is all allowed, is just mitigating capital gains tax. If you held investments in a portfolio that wasn't in an ISA or it wasn't in a SIP, so it's liable to capital gains taxation, you could sell the investment and buy a very similar one. So let's say you had an S&P 500 tracker of some kind that was provided by one investment company. You could sell that down and the very next day use those proceeds to buy another S&P 500 tracker with another company. So you've effectively got the same investment. They're so similar, but they are different from taxation purposes. So that way you can therefore stay in the market, not have to wait 30 days as the rules would normally state, because if you sold the original tracker and bought it back again, you'd have to wait 30 days. So you wouldn't be liable to capital gains tax. That's the rule. But you can buy a different but similar investment. So that's what some people would do if they're being very shrewd. Moving on from capital gains tax, you could put money into a junior ISA as well. Don't forget there's a £9,000 a year limit for each child that you can put money into a junior ISA. So maybe think about that. And I will obviously mention VCTs and EISs, so that's enterprise investment schemes and venture capital trusts. They give generous tax reliefs that are relevant to each tax year. I'm not going to go into any details because if you go back, I talked about them, I think 2 episodes ago, so you can find out more about those investments, but they are very specialist investments and for people who are very sophisticated investors. But I mention them because I want to make the list complete. From a tax mitigation perspective, there is a concept of considering disposing of capital losses. So you could theoretically offset a capital loss somewhere against a gain somewhere else, and that happens in the same tax year, that will therefore reduce your tax bill. And you can also carry forward capital losses, but you have to declare them on your tax return within 4 years. There's also, from a tax perspective, the marriage tax allowance. Search marriage tax allowance on our website. You'll find an episode where I talk about it, but quite simply, if your spouse has unused personal income tax allowance, then you may be able to effectively borrow part of their tax allowance and it can reduce your tax bill by basically a few £100s. So that's something to think about. And you can backdate that claim for up to 5 years if you've been eligible, not realised. So again, there is a link in the article we're going to put in the show notes and at the bottom of the article that's on the website for this podcast episode that will link to more information about that marriage tax allowance. Of course, there is the idea that if you're thinking about that CGT thing again, don't forget you and your spouse have separate allowances, so you could move assets into their name and use their allowance if you've used yours already. So that's something you can do. Of course, you have to realise when you're moving investments into other people's names, they technically own them. And so if you're going to do that, then I hope you're in a very happy and stable marriage. Otherwise, things could go slightly awry. There are obviously inheritance tax limits as well. So they can be used to reduce a potential IHT bill on death. Don't forget you've got an IHT allowance of £325,000 each if you're in a married couple, and you've also got that additional allowance for your property if you own a property and you pass it down to your dependents. That can theoretically mean you can pass £1 million together onto the next generation. But the annual allowances for inheritance tax include a £3,000 allowance which can be carried forward for 1 year as well. So if you don't use it the previous year, you can use it the next year. That's just a £3,000 that you can give away to somebody. It's a single allowance. So it's not £3,000 per person that you give money to. It's £3,000 in total. You can give up to £250 a person, but not in conjunction with any other inheritance tax allowance. You can give £5,000 to a child who's getting married and £2,500 to a grandchild or great-grandchild getting married. And that, again, won't be liable to inheritance tax if you were to then die. And the last one I'm going to mention is regular gifts from income are inheritance tax free. So the size is irrelevant. A lot of people don't realise, as long as you can maintain your normal lifestyle after making them. So you will want to ensure that you keep records to prove this, because if you were to die, then HMRC may question whether these were gifts that needed to be taxed. So you need to prove that your lifestyle wasn't impacted, and it really includes income from things like employment income and stuff like that you may have left over. But grandparents could use this to fund a pension for a grandchild, for example, which is obviously tax year sensitive. So the reason we mention that is that the regular gifts aren't tax year sensitive, but what you do with them may well be. So you may use that income to do something that you need to do before the end of the tax year. But these are all things that you can think about. We'll link to the article and you can find out more information that way.
Okay, so energy has been high on the agenda and massive in the news at the moment, but we're not going to cover the main story. We've done that already. We know what's happening with energy prices. And we had a question from a listener which got us all thinking in the office. Yeah, actually, why is that? So the question was, I'm on a green energy tariff. Surely I'm not impacted by all of the price increases that are happening because of the price of oil and gas. If I'm green, why is it happening? What's going on?
Yeah, so this is quite interesting because it will give people an understanding of how our energy market works. It's quite complex, so we're going to hit it at quite a high level. But apparently, about 9 million households are signed up to green energy tariffs. And the reason people will normally do it is because they want to be using renewable energy. They are being conscious of the environment. Now, the problem is that they are also seeing their bills go up because they may be thinking that the oil and gas price rises that you're seeing in the news that are pushing up energy prices shouldn't impact them, but it does. And the reason is because the way energy works in being delivered to you. So the reality is that if you're on a green tariff, you will get exactly the same energy mix as, say, your neighbour who isn't on a green tariff. So if you're thinking about the electricity that you might be getting, then you are getting the same mix as the person from next door. There's not pipelines that's coming down with only green energy on. And what happens is our energy comes from a number of sources, and they are mainly coal, gas, nuclear, wind and solar energy, but it's all pumped into the national grid. And on average, about a third of our electricity is from renewable sources, but more than a third is powered by natural gas, with the rest coming from those other sources I mentioned, including nuclear. So that means that if you're on a green energy tariff, because more than a third comes from natural gas, so they use natural gas to produce the electricity that you're going to use, then the impact of the price of natural gas is going to feed through. It's going to impact your bills as well. Now, you can't specify that you only want green energy. So these price rises you're seeing and reading about are going to impact everybody. It's not until we're in a world where maybe the UK completely generates renewable energy from sources like wind farm or maybe solar that we're going to shift away from this model. And it's not the only way we could even do it is if we create another national grid of some kind that only had renewable energy sources in it. Well, that's not going to happen. So how can people say your energy tariffs are green? Because that's the next question that will be coming. And it's because they do one of three things. So the greenest thing they can do is they can invest in renewable energy products such as wind farms and solar energy farms directly. Now, there are some companies, so energy firms, that do that in order to generate electricity.
So on that, your money is being paid to them. They're then using that money to invest in the actual product itself, which fulfills the green quota.
Yeah, and so that is unusual. So there aren't many companies that actually do that directly. So the other way you can do it is the energy companies will sign contracts with green energy producers to buy the energy they produce. So in this way, they're using the existing grid and slowly replacing the input from non-renewable sources to renewable sources.
So that in that way, they're sort of growing the infrastructure. They're making it bigger.
Yeah, because they're buying energy from renewable sources, and it's not until that kind of grows over time that we will end up being able to all have green energy. The other thing is it's all very complicated, so I'm hitting it at a very high level. But the third and most common way that energy companies actually have their green credentials, it's not quite greenwashing, but people are very critical of it. What they can do is they can buy certificates known as, I don't know how you say this, but if it's REGOs, that's shortened to REGOS, which stand for Renewable Energy Guarantee of Origin, which are effectively certificates that are issued every time a unit of renewable energy is produced somewhere in the UK at some point. And they cost around about £2, and that will cover the energy production of a typical household for a year. Now, there is a problem with that because they aren't investing directly in the energy infrastructure. They're buying these certificates to say, well, energy was produced and where's buying these certificates that will effectively match the energy usage of their customers, if that makes sense. And that way they can say that while customers may be using non-green energy, they are supporting renewable energy production via these certificates. But there is a grey area that comes into all this. So if you imagine there is a company that took Route 2 that I mentioned. So they, as an energy provider, are signing contracts with energy producers that are producing green energy. Then when they get that energy, these certificates are also produced along the way because some energy has been produced somewhere in the UK. But the people receiving the certificates could sell them on to another energy provider.
So sorry, in accounting terms, I think this is called double counting.
This is double counted.
Right.
So theoretically, you could, or people are saying that we could be getting double counting going on in the energy market. So somebody who is on a green energy tariff, their electricity, for example, could be classed as a green tariff, but the renewable energy was actually bought by somebody else, but they've kind of taken credit for that at the same time. So it's all very confusing, but what it boils down to is that the green energy market probably isn't quite what people think it is. And it's like a lot of things out there. If you want to be green, it isn't always that easy. So the other thing that I'm going to probably destroy some people's views on green energy, I don't want to, but it's just the reality, is that if a company took Route 1 and invest directly in renewable projects like wind farms and solar energy farms, then they can become exempt from the energy price cap. And there are companies such as Ecotricity and Good Energy, they have special dispensation from Ofgem to not have to adhere to the energy price cap, which is obviously very relevant because as we make this podcast today, Andy, the energy price cap has just gone up. So what that means is you could theoretically be paying more for your energy than your neighbour who doesn't care about the environment. So again, we're getting into that world that if you really want to be environmentally friendly and green and use renewable sources for whether it's food, electrical cars, anything like that, you can end up having to pay more for that privilege. So the upshot of the piece is that green energy is still a positive thing to try and go after. But what you need to do is look under the hood of your energy provider if this concerns you at all, because they do have to publish on their website the fuel mix of their electricity supply and how it compares to the UK average. But there are websites like Uswitch have a comparison site which issues gold, silver and bronze accreditations for green tariffs. And for example, gold is likely to only be those people who do really invest in those renewable projects directly. So if you are concerned about that, then go and look at somebody like Uswitch who do have that accreditation on their websites.
And if you really, really want to go green, then you really have to pump the money in and put a solar panel on your roof or a windmill at the bottom of your garden, I think.
Yeah, and then as we know last week, you probably won't be paying VAT on that, if that's what was announced in the spring statement. But again, that's something completely different. But this is just for people who we're talking about on green energy tariffs.
Okay, and so the last piece of the podcast, we're going to be focusing on money fears. And it's things people don't really talk about.
Yeah, you're right. And we spend a lot of time talking about goals and setting goals to do with money and what you want to do. But we don't often talk about our fears with money. And actually, fears dictate a lot of our behaviors in not in just relation to money, but in the real world. So if you sit there and think about anything you're worried about, things that make you anxious, and let's be honest with you, I think nearly everybody listening to this podcast would probably admit that they're probably anxiety levels, fears and all those are much more heightened than they were a couple of years ago, thanks to what happened in the pandemic, I think. So there are things with money in particular, I think there have been fears that have grown over time. I can speak for myself, I think that's definitely true. And so our fears dictate a lot of what happens with our money and actually how successful we will be at trying to achieve our goals and how happy we will be. And they can, at extremes, materially impact your wealth. Now, I'm going to just give some examples off the top of my head that are very typical money fears. So an example could be being a victim of a scam or having your identity stolen online. There are people who will be so worried about that starts to hinder them in terms of what they will do in terms of their finances. There'll be people worried about losing all their money in a stock market crash. Now that would have been a fear that became particularly prevalent after the financial crisis. We talk about the financial crisis all the time and we reference it because it was such an extreme event, particularly in investment markets, and the pandemic too. So these big almost black swan events that occur do scar generations going forward and their behaviors in investing. And when you don't have one of those periods for a while, what you see is that behaviors in investing markets start to change, because you get younger people who come in who haven't experienced such an extreme event and therefore will be more reckless. And it goes back to, there'll be people who are really worried about interest rates going up to like 12% because they remember when they were before. So interest rate rises could be an issue, not being able to afford your mortgage. Another one could be a black swan event that could wipe out your business or your wealth altogether. And losing your job is another one. So these are typical money fears. If people are sitting there nodding away, that is good, because that's what I want you to do. And there'll be people who might have a money fear that they'll never have enough money to be financially independent. I think there are people definitely veering towards that now because of the interest in financial independence. And that means that you're able to get to a point where you won't have to work, or you can choose whether you want to work or not. People become obsessed with that, and they become obsessed that they'll never be able to be financially independent. Or you could replace the words financially independent with the word retire. People who fear they'll never own a house, and there'll be people who fear that they will never get out of debt. So what I want people to do is admit to themselves what is their money fear. And the reason that you need to do that is because it will help you to overcome them. So there are people, another one I've heard is people who spend too much. They're worried that they're going to end up blowing all their money, or they won't have any money left over because they're serial compulsive spenders. And so they will buy things frivolously. So if you have a fear, some good tips on how you overcome them. And this has been adapted from official guidance from the NHS about coping with fear. And one of the things you should do is face your fears. So you need to own it. You need to face what it is that you're really worried about. And then the next thing you need to do is imagine the worst thing that could happen. Imagine that worst case. Okay.
That sounds counterintuitive, but I suppose it's part of that process of getting through it.
It is, because I think what they're trying to do is get you to really face up. The fear itself can be all consuming, and there are different types. I mean, I'm no psychologist or psychiatrist or anything like that, but you see people who have a fear of, it could be something as common as spiders, and then often you'll get them, they'll start to think, well, what is the worst thing that can happen? And then they end up handling them, and it starts to overcome some of those fears. But with the money world, you imagine what the worst could happen. I'm going to run through an example with this before we finish up. Then you need to look at the evidence. Okay, so what's the evidence suggest about the likelihood of that fear coming to fruition? But not only that, look at the evidence of what would actually happen in the scenario if that was to occur. So how would life really pan out? And the other thing is, don't try to be perfect. So don't try and aim for perfection. And I think this feeds into our fears a lot, that we're trying to be perfect or have the perfect life. And the final thing, which is probably the most liberating, is to talk about it. So you need to own it and own up to what your fear is and happily talk about that, because it's like a shadow. So fears are very much like shadows. So when you shine a torch on them, they start to dissipate because you start to illuminate them and the shadows go to the corners.
I like that analogy.
Yeah.
I've not heard that one before.
I will admit that I stole that from Eckhart Tolle. If you want to know what Eckhart Tolle is,
Yeah.
He wrote a book, The Power of, I think it's The Power of Now and The New Earth. Fantastic books. Oprah Winfrey did a podcast series with him, actually, so it's worth listening to. It will change your way you look at life. But you need to talk about it. So I'm going to quite happily talk about my own money fears. Well, one in particular, I got a money fear, and mine is more to do with perhaps that black swan event that will come, that will wipe out my wealth, but more importantly, money to the masses in our business, because we support a lot of people. But then you've got to look at that and go, well, what is that fear? That's the fear of effectively being unprepared, or the worst happening. The worst that could happen is that, for example, I didn't earn any money for a period of time. And what's the longest period we could think that that could happen? Now, for a lot of people, the pandemic, I know people where unfortunately their businesses folded during the pandemic. And even in the most extreme case, they were taken probably a year, 18 months to recover, especially if you're in an industry such as travel, which was really badly hit. So when you look at the evidence, what I'm really needing to focus on is, can I survive for a period of time where we don't have income streams, whether personally or as a company? And so you end up building that buffer, that cash buffer for the rainy day that if these things happen. And rather than become obsessed with it, it's quite good to use mathematics, so looking at the evidence, trying to work out, well, how much do I need to put aside in order to build a big enough buffer? How much does that buffer really need to be? And the reality is it's not as big as I probably had feared, because really I probably could survive. If I could survive a year, then the world would probably move on and there's support mechanisms, and I would pivot and do something else. I'm not going to be somebody who wouldn't go and do another job of some kind if I needed to get the money in. So you look at the evidence and you start to think, well, how much do I need? So you start to set aside. And a very good way that helped me mentally, certainly from a business perspective, was to come up with a formula dictating how much you would put aside from any profit that you made. And what was good about doing that was that even when you get a year or period of time where you start to become lean or leaner because of things that are going on in the world that you have no control over, then you dictate the amount that you will put aside and what you will do with that money, because you're following a set formula. So it may be, for example, a director who works in a company, somebody who's running a limited company, they dictate what size dividends they might take. And so rather than just being fearful of an event, they're actually navigating it by planning ahead. So when things get tight, everything naturally tightens down, if that makes sense. So you're starting to maybe invest less in certain areas of the business, or when they're growing, you put more aside. So that helped. And don't try to be perfect was quite important, because you realize I can't control everything. And as soon as I realize I can't control everything, it's much more liberating. And for me as well, like when we're talking about things like paying your mortgage, I've just moved house. And inevitably I would take on a bigger mortgage to do that. I then became very conscious of that, and therefore started to look at what's the worst case scenario. How high could interest rates go? What is the reality? How would I cope if they did? But by looking at it, imagining the worst, I then realized we had a lot of ways in which we could end up making things work. And if I had to get a second job, I would. And so that helped me quell the money fear of mine, which was about some of these black swan events. And the reality is, when I looked at the evidence, the black swan events only happen on average at most about once a decade. So the financial crisis was 2008, the pandemic was 2022, that was like 14 years later. So you have them in these big black swan events happening in cycles. So you realize they don't happen as often as you thought they would. And the last two crises, I had survived them in what I was doing and jobs that I had at the time. So I had to realize that the fears were starting to hinder me, because I was starting to become not quite Scrooge, but I was becoming probably overly frugal, and realizing that, you know what, happiness doesn't always lie down that path. I needed to lighten up a bit. And so by doing that, that made me a bit happier, and the fear basically stopped me not living life and enjoying things, and actually occasionally giving myself the ability to enjoy money occasionally as well, and being able to do things because it was all part of a plan. So that was me trying not to be perfect. And talking about it helped, because you'd sit there and have an opposite view, whether it's with my wife, whether it's with other people, directors in Money to the Masses. So do talk about it. And the last thing I want to finish on that is that it also accelerated the movement towards having things like income protection, making sure I have life insurance in place, the ability to look at critical illness insurance, basically to protect the life that I had. But at the same time, what it did do, it accelerated that movement within us as a company. So we now have group life insurance at Money to the Masses. We have income protection as well for employees, because I realized that responsibility of looking after people, I could insure against that disaster. And so for me, that makes me sleep better at night, because I haven't got to worry about other people's families relying on me to do what I do as well. So it's a very good exercise for people, and it makes me sleep better at night. And I hope by facing money fears that at least admit them and start to work through them, that I think we could all enjoy life a little bit more.
No, that's a really interesting piece. And I think perhaps we're not ones for setting homework, but listening to what you were saying there, it is something I'm going to take away, and I'm actually going to do that as homework myself. I'm going to think about what that sort of fear is, and really dig down into it, and start speaking about it. Imagine that scenario. What's the worst case scenario? And I think listeners should do the same. I think it's a really good, worthwhile exercise.
And maybe if listeners want to, they could send in their money fears. That might be something we could do, and that we could talk about them anonymously and how you might overcome them. Because the one that's there looking at me in the face about losing money in the stock market, I think that is quite a big one. that people worry about losing money, but what they have to do is make less emotional decisions. And if people want me to go into that a bit more in the future, then write in the Facebook group or send me a message on social media, and then we can come back to this topic, because I think it will be quite a popular one.
What's interesting as well about that is I hadn't truly appreciated, now having listened to you, that my family have been through one of these black swan events that wipes out a business. My wife lost her business through the pandemic. Talked to me 2 years prior to that, and if someone had said to me, your wife will lose her business, well, that for me would be the end of the world. And actually, we got through it. It was fine, and things move on.
Yeah, so. and that, Andy, is a great example that people shouldn't underestimate their own resilience and their own initiative and ability to adapt and change. Because I think the things we fear when the chips are down, I think people have to realise they are far more resilient and creative and have initiative to be able to overcome some of that stuff. So sometimes you have to just start trusting yourself and then bigging yourself up a bit, actually, saying that, you know what, we'll be okay because you've got the tools to be able to survive that scenario. You're not going to sink. It's a sink or swim scenario, and most people would start swimming.
Yeah, absolutely. So if you want to get in touch with Damien, you can do so in the usual way. It's Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with the number 2. And don't forget, next week, we're going to be reading out lots of our reviews. So if you want yours read out and a chance to win a Money to the Masses mug, make sure you review the podcast. And so, Damien, that's it. We're done. Until next time.
Until next time.